Did you know that in March 2020, the stock market saw its fastest drop into a bear market in history? That kind of volatility can send shivers down the spine of even the most seasoned investors. It's a wild ride out there, and today we're diving into a recent event that shook the market, triggering circuit breakers and leaving many traders in a state of panic. Alright, folks, let's talk about circuit breakers. So, what are they? In simple terms, circuit breakers are mechanisms designed to temporarily halt trading on stock exchanges when there's too much volatility, or when prices plunge too quickly. Think of them as a safety net for the market. They help prevent panic selling and allow traders to take a step back, reassess, and make more informed decisions. These things are super important, especially during extreme market conditions. They provide a moment to breathe, to think, and to avoid a complete market meltdown. Today, we'll explore how these mechanisms work and what happened during the recent wave of selling that set them off. Presentation of problem/challenge. Now, let's get into what actually triggered the circuit breakers this time around. In the past few weeks, we saw a sudden surge in selling pressure across the board. It felt like a tidal wave crashing down on the market. Investors were hit with a mix of bad news, from disappointing earnings reports to geopolitical tensions and even economic indicators that weren't looking too rosy. It was a recipe for disaster. Traders, fearing that the market might nosedive even further, started offloading their stocks in droves, leading to an overwhelming amount of sell orders flooding the exchanges. This kind of panic can be contagious, and before long, the market was in free fall, triggering those all-important circuit breakers. Exploration/development. Let's break down how circuit breakers actually work. There are different levels that can be triggered, depending on how much the market drops within a specific time frame. For instance, if the S&P 500 drops by 7% during the trading day, trading is halted for 15 minutes. If it falls by 13%, that halt extends to 15 more minutes. And if it plummets by 20%, trading is suspended for the rest of the day. This layered approach is designed to give investors a moment to gather their thoughts and avoid making knee-jerk reactions that could worsen the situation. It's like pulling the emergency brake on a runaway train, giving everyone a chance to cool down. The hope is that, after the pause, traders can return to the market with a clearer head. Climax/key moment. So, picture this: the market was plunging, panic was setting in, and suddenly, bam! The circuit breakers were activated. It was a tense moment. You could almost feel the collective gasp from traders everywhere. The screens went blank as trading halted, and for 15 minutes, everyone held their breath. It was a roller coaster of emotions, fear, uncertainty, maybe even a hint of hope that things would stabilize. When trading resumed, many were surprised to see a slight bounce back, but not before the damage had been done. That moment of suspension was both a relief and a reminder of how quickly things can change in the market. Conclusion/summary. To wrap things up, circuit breakers play a crucial role in maintaining market stability during turbulent times. They're like a safety valve, allowing traders to pause and reassess before making potentially harmful decisions. The recent surge in selling highlighted just how important these mechanisms are in the face of sudden waves of panic. For investors, understanding how circuit breakers operate can inform future trading strategies and help navigate the unpredictable waters of the stock market. Call to action, CTA. I want to hear from you. How did you react to the recent market events? Did you feel the panic, or did you see it as an opportunity? Drop your thoughts in the comments below. And if you're interested in learning more about stock market strategies, don't forget to check out my previous videos. Thanks for watching, and I'll see you in the next one.